stop scrolling for a second. Because this story isn't silver is volatile, and it isn't people on the internet are mad. This is about something official, documented, and admitted through real legal resolutions. Regulators described a long-running pattern of deceptive trading in precious metals, gold, silver, platinum, palladium, where traders used a tactic called spoofing to move prices and extract profit. And if you've ever watched silver rip up, then instantly get slammed down like an invisible hand hit a switch. This is the mechanism that can explain at least part of that behavior. Here's the clean version of the claim we're covering today. U.S. authorities said a major bank's precious metals desk engaged in spoofing and other manipulative conduct for years, roughly spanning the 2008-2016 window for precious metals in the DOJ description, and the overall enforcement actions and resolutions announced in 2020 totaled around $9 and $20 million across DOJ, CFTC, and SEC actions. That's where the "they admitted it" framing comes from, not because someone made a meme, but because official releases describe the conduct, penalties were paid, and the paperwork exists. Now, we're going to do this the right way. I'm not here to tell you every single tick in silver was controlled by one villain. Markets still move on macro, rates, positioning, real supply, and demand. What I am telling you is more precise and more dangerous. The order book, the thing you assume is a truthful representation of supply and demand, can be weaponized. Spoofing is basically lying to the market with size. It always creating a fake wall of buying or selling pressure to force other people and algorithms to react, then executing your real trade in the direction you want, then deleting the lie before it fills. And because modern markets are run by machines that respond to microsignals in milliseconds, a lie that exists for 1 second can still move price enough to trigger stop losses, force liquidations, and flip the whole short-term narrative. That's the money glitch. Not magic, not conspiracy, microstructure abuse. And this is exactly why regulators treat spoofing as illegal. It's not competitive trading, it's deception. So here's what we're doing across these 5 parts. First, you'll understand spoofing so clearly you can explain it to a friend in 20 seconds. Second, we'll map how a spoof can translate into real chart damage, stop runs, V-shaped recoveries, sudden dumps with no news. Third, we'll lock the timeline and the official language so the story stays factual, not emotional. Fourth, we'll talk about why the punishment, the legal structure, and the incentives matter, because even after a case becomes public, the market's temptation to repeat the playbook doesn't vanish overnight. And fifth, I'll leave you with a practical, real-world framework, what to watch, how to protect yourself from being emotionally manipulated, and how to talk about this on a channel without turning into a conspiracy machine. Because your credibility is everything. If you cover this like a serious documentary, people trust you. If you cover it like a rage post, you get clicks, but you lose authority. Now let S set one more rule before we go deeper. Dawn to confuse, rigged with hopeless. Nos. The fact that spoofing happened doesn't mean you can't invest. It doesn't mean fundamentals don't matter, and it doesn't mean every move is fake. It means you need a new lens. You need to understand that sometimes the market is not reacting to reality. It's reacting to a manufactured illusion designed to make you act at the worst moment. And once you understand that, you stop being the victim. That's the whole point of this video. So let's begin with the simplest possible explanation of the cheat code in part 2, because once you see it step by step, everything you've ever felt about mystery silver moves starts to make sense. Picture the market like a crowded auction room. On one side, you have people bidding to buy. On the other, you have people offering to sell. The price is just the point where those two sides meet. Now imagine someone walks into that room and pretends they're about to dump a massive supply. So massive that everyone in the room panics and backs away. But the twist is, that person never intended to sell that supply. They only wanted the room to believe it was there for a moment. That's spoofing. In practical terms, a spoofer places large orders on one side of the book, often layered at multiple price levels, to create the illusion of heavy supply or heavy demand. The orders are real in the sense that the exchange sees them and the market sees them, but they're not real in intent. The intent is to cancel them before execution. The goal is to move the price or move other participants. Here's the most common version. The trader wants to buy, but buying openly pushes price up, so they manufacture sell pressure first. They throw a giant sell wall above the current price. Algorithms and humans see huge supply, and they react. Some buyers pull their bids, some sellers hit the market, some stop losses trigger, the price dips. While the market is dipping from that reaction, the spoofer quietly buys with smaller real orders on the bid side. Once they're filled, they cancel the fake sell wall. The illusion disappears, and price often snaps back. On a chart, you see a sudden drop and recovery. People call it volatility, but structurally, it can be engineered volatility. Now flip it for selling. The trader wants to sell without pushing price down, so they create a fake buy wall, make the market rise, sell into the strength, then cancel the fake buy wall and let the market fall back. That's why spoofing is so powerful in thin windows, overnight sessions, low liquidity moments pre-market around data releases, because it doesn't take much to shock the book when there aren't too many real orders standing in the way. And here is the truly modern part. Even if the spoof orders exist for a very short time, high-frequency systems can react instantly. You don't need the lie to last long. You need it to last long enough to trigger a chain reaction. Markets are full of tripwires, stop losses, margin thresholds, liquidation engines, option barriers. If you nudge price into a cluster of stops, the forced selling becomes your free momentum. The market then does the work for you. And that is why a tactic that starts as a fake wall can end as a real cascade. Another layer that matters for precious metals is the psychological context. Gold and silver are watched by people who are already emotionally charged. Inflation fear, currency distrust, central bank narratives, safe haven psychology. That makes the crowd more reactive. And in reactive markets, deception works better. Now you might ask, how do regulators know intent? Because intent shows up in patterns, placing large orders that repeatedly get canceled, placing them on one side while executing on the other, doing it again and again, layering orders away from the inside market, pulling them the moment price moves, and creating a consistent footprint across time. That's the part people miss. The smoking gun is repetition. One cancellation is normal. Thousands of similar sequences across years is a strategy. And authorities described exactly that kind of repetition in their public summaries. Not a single bad day, but a sustained pattern over years in precious metals markets. So the takeaway of part 2 is this. Spoofing isn't T, someone sold a lot. C's. Spoofing is someone pretended to sell a lot to make you sell so they could buy cheaper, or the reverse. It's market theater designed to move your emotions and your algorithms. And once you accept that order book theater exists, you become far less likely to chase a sudden candle. You stop believing every wall you see. You start asking, is that wall real or is it bait? In part 3, we were going to lock the story into the official timeline and what was actually said publicly by authorities, because that's how you keep this topic powerful and credible. Let's talk timeline and facts in a way that's strong but disciplined, because this is where most videos either get lazy or go too far. The core public story people reference comes from enforcement actions, and a DOJ deferred prosecution agreement announced in 2020 tied to precious metals and also U.S. Treasury markets. In the DOJ's public description of the precious metals side, the conduct was described as spanning roughly from March 2008 through August 2016, involving thousands upon thousands of deceptive episodes in precious metals futures, gold, silver, platinum, palladium. That range is the backbone of the 8 years, framing people repeat. And the key point is that this isn't a random internet estimate. It's rooted in how the conduct period was publicly described. Then you have the regulatory enforcement language, where the CFTC characterized its action as record-setting and described the scale in terms that are hard to ignore, talking about hundreds of thousands of spoof orders across the relevant markets. Again, the exact legal details can be technical, but the story is clear. The alleged behavior wasn't a one-off, it was repeated. And repetition is what turns a tactic into a scheme. Now, there is another piece that makes this story land emotionally. This wasn't T-only corporate paperwork. There were individual prosecutions and convictions tied to the same pattern of spoofing and attempted price manipulation. That matters, because it tells your audience this wasn't T just a bank paid a fine and walked away. Human beings were charged, cases went through court, and there were sentences. That's why the story has weight. Now, we need to be legally honest in our language while still being direct. A deferred prosecution agreement is not the same as a guilty plea. It's an agreement where prosecution is deferred under conditions. The company typically accepts a statement of facts for the agreement, pays penalties, and related amounts, cooperates, improves compliance, and after the term, the case can be dismissed if obligations are satisfied. That structure is exactly why critics say these can feel like cost of doing business, even when the number is massive. And in this particular narrative, people point to the size, around $920 million across the combined actions, as either proof of seriousness or proof of how profitable the activity might have been if the market tolerated it for years. But here is how you present it without speculating beyond the record. You say the official releases described multi-year spoofing. And manipulative conduct, you say the resolutions totaled around $920 million, and you say this triggered a major debate about accountability and market integrity. You don't need to claim secret profit totals. You don't need to claim the entire market is fake. You just need to hold the viewer asks attention with the truth. Deception at scale can distort how price discovery feels. Now, connect the timeline to what viewers experienced. The 2008-2016 window includes the post-crisis era where metals became a battleground narrative. It includes periods where silver had violent spikes and violent crashes. It includes the maturation of algorithmic trading dominance, where microstructure became everything. So even if fundamentals were driving the big cycles, microstructure abuse could amplify the pain at the worst moments, turning normal volatility into weaponized volatility. That's why this case became so iconic in the metals community. It gave a name and an official trail to something people felt for years: sudden dumps, fake walls, stop hunts. Why did price just do that? But the most important discipline is this. The existence of spoofing doesn't entice. Didn't T-prove every dump was spoofing. It proves a tactic existed, was described as illegal, and was used repeatedly in ways regulators summarized publicly. That's enough to justify the documentary. And it sets up part 4, where we stop treating this as history and we start treating it as a lesson about incentives. Because here's the uncomfortable truth. When you expose a cheat code, you don't erase the desire to cheat. You force it to evolve. Now, let's talk about why this matters today. Because a lot of people treat this like a closed chapter. They got caught, they paid, the end. That's not how incentives work. Markets are competitive environments where tiny edges matter and where speed plus size can bully price in the short term. If a tactic produced profit for years before consequences arrived, the lesson for predators isn't never do it. The lesson is do it smarter, do it cleaner, hide it better, spread it out, or shift tactics. That's why your audience needs to understand the psychology more than the headline. Spoofing is not just an order book trick, it's a weapon aimed at your nervous system. It's designed to create urgency and certainty at the same time. Urgency, act now. Certainty, look at that massive wall, the move is guaranteed. When you feel urgency and certainty together, that's when you make your worst decisions. Chasing, panic selling, revenge trading, over-leveraging. A spoofer doesn't need to control the market forever. They just need to control you for 30 seconds. Now, the bigger lesson is about market structure. Modern futures markets are fast. Liquidity is fragmented. A lot of what looks like depth can vanish instantly. And because so many participants use similar signals, order book imbalance, momentum triggers, breakout levels, one shove can trigger a crowd stampede. That's why spoofing was so effective in the first place. It exploits predictability. And here is success, where your channel can add massive value. You can teach viewers to recognize conditions where deception is most effective. Thin sessions, pre-market, just before major data drops, during low participation holidays. In those windows, you don't treat the first aggressive move as truth. You treat it as a test. You wait for confirmation. You watch whether the move holds when real volume arrives. Another lesson is how to speak about accountability without turning it into a political rant. You can say, this is why people lose trust in markets, because if order flow can be manipulated, the concept of fair price discovery gets damaged. Then you can say, the legal system used a deferred prosecution agreement structure, and that structure is controversial. Some say it's necessary, some say it's too forgiving. That frames the debate without making claims you can't prove. And that matters because your goal isn't just views, it's authority. Now, let us connect this back to the present silver narrative your viewers already love. Physical versus paper. Physical demand shows up differently. Premiums, deliveries, inventory dynamics. When your viewers see price slammed while physical premiums stay high, they feel the disconnect. Spoofing is one possible explanation for why paper price can behave violently even when physical demand exists. Not the only explanation, but a real one. And that's a powerful storyline because it doesn't require conspiracy. It requires understanding that paper markets are leveraged, fast, and vulnerable to microstructure games. So the practical message of part 4 is don't become cynical, become calibrated. Don't scream rigged at every red candle, and learn how to protect your behavior. If you're a trader, your weapon is risk control and timing. But either way, your weapon is emotional discipline. In part 5, I'm going to give you a simple, repeatable watch list that fits your channel format. What to look at this week, what patterns to respect, what patterns to ignore, and how to end the video with a punch that feels like a documentary conclusion, not a meltdown. Here's the final part, and it's the most practical. I'm going to give you a framework you can use every single time you see a mystery move in silver. Think of it as your anti-manipulation checklist. First, identify the liquidity window. Ask, is this happening when the market is thin, overnight, pre-open, around a major data release? If yes, the chance of engineered micro moves is higher, not because everything is fake, but because thin books are easier to bully. Second, watch the shape. Spoof-like behavior often creates sharp, unnatural spikes or dumps followed by quick snapbacks, because the fake wall disappears the moment the real trade is filled. A snapback alone isn't proof, but a repeated pattern is a warning. Third, watch for level targeting. If price repeatedly gets pushed just far enough to grab obvious stops, hit a round number, or tag a key level in reverse, that's a pattern consistent with hunting liquidity. Again, not proof of any single actor, but proof that the market is behaving like a liquidity hunting machine. Fourth, separate paper stress from physical stress. If physical premiums remain elevated for weeks while paper price gets whipped around, you treat paper price as noisy and you focus on the structural story. Is there persistent physical demand pressure, or is retail just repricing? Fifth, measure repetition. One weird candle is entertainment. 5 weird candles in the same window, same style, same behavior. Now you have a signal worth respecting. Now I'm going to give you the documentary ending voiceover, because this is how you close strong without promising the future. You say, for years, regulators described a pattern of deception in precious metals markets, spoofing, attempted manipulation, and tactics designed to mislead other participants. The resolutions were massive, the timeline was long, and the story wasn't just corporate. It involved individuals, prosecutions, and real consequences. That's the record. But the deeper lesson is not about one bank. It tells about how markets can be exploited when speed and size are allowed to manufacture false narratives. And once you understand that, you stop being shocked by the mystery moves. You stop taking every wall as truth. You stop chasing the first candle. You stop letting the market hack your emotions. And that's where the power shifts, because the real victim of spoofing is not the market. The victim is the trader who panics at the exact moment the spoofer wanted. Now you tie it to the viewer. If you are here for silver because you care about inflation, currency debasement, and the future of real value, then you can't afford to be manipulated by microstructure theater. You don't have to predict every move, you just have to stop donating money to the traps. And the way you do that is simple. You respect liquidity windows, you demand confirmation, you track patterns, and you keep your risk under control. Then you finish with one line that hits. They didn't because it need to control the market forever. They only needed to control you for a few seconds. Don't give them those seconds again.